is still elevated. Goods inflation has declined significantly as supply shocks wear off, but there is evidence of stronger inflation in services across a range of economies. Meanwhile, unemployment rates remain low, especially in the United States. In these circumstances, major global central banks are expected to cut rates at a slower pace and to start cutting at a later stage. A few emerging market central banks have been reducing rates already. But these economies had the largest hikes previously, and their interest rates are now well above inflation. The Monetary Policy Committee also noted that the Bank of Japan has moved its policy rate into positive territory, increasing interest rates for the first time since 2007. Turning to South Africa. The economy performed worse than expected in the fourth quarter of last year, expanding just 0.1%. Growth for 2023 as a whole was 0.6%. The main reason for this bad performance was supply-side problems. Electricity load shedding was worse than in previous years. Port and rail problems also emerged as binding constraints on output. Our forecasts indicate a modest growth acceleration from this year as these supply-side constraints relax. In particular, we expect the load shedding burden will ease somewhat. While we estimate electricity shortages took 1.5 percentage points off GDP last year, we expect this to moderate to 0.6 percentage points this year and 0.2 percentage points in 2025. Overall, we see growth at 1.2% this year, improving to 1.6% by 2026. These projections are better than the 2023 outcomes, but below longer-run averages, which are around 2%. The risks to this growth forecast appear balanced. Turning to inflation, South Africa had a more gradual acceleration in inflation than many peer countries, with a lower peak after COVID. However, the return to target has been slow. The most recent inflation numbers showed yet another delay on the way back to our 4.5% objective, with headline up to 5.6% in February. This is nearer the top of our target range than the midpoint. Core inflation also rose to 5%. This rise in core was due to an acceleration in services, which was led by the medical aid component. Services inflation is now at its highest since 2019. This suggests that South Africa is joining the global trend of services rather than goods becoming a major source of inflation. The committee still sees headline inflation heading back to 4.5%. However, given extra inflationary pressures, headline now reaches the target midpoint only at the end of 2025, which is later than previously expected. As a result, the policy stance in our baseline forecast also starts to normalize later. In assessing this forecast, the MPC noted a range of risks. Inflation expectations have moderated in the latest survey. This is welcome but 2-year ahead expectations are still in the top half of our target range. Expectations are projected to ease towards our 4.5% objective as inflation slows, but we have little margin to absorb shocks as long as inflation expectations are high. Regarding food prices, we are at a difficult juncture. Last year, food inflation hit the highest levels since 2008. Food inflation has now slowed, but this is a critical time in the growing season, and the weather has been unusually hot and dry, which may cause food inflation to pick up again. Considering the exchange rate, the rand has been trading somewhat weaker than we expected at our last MPC meeting. This is partly due to interest rates in the major advanced economies staying high for longer. The currency is also under pressure from weakening terms of trade. Furthermore, investors see significant near-term domestic uncertainty. We view the exchange rate as undervalued. On balance, the various risks to the inflation forecast are skewed to the upside. Against this backdrop, the MPC decided to hold the repo rate unchanged at 8.25%. The decision was unanimous. At this level of raise, the policy stance is considered restrictive, consistent with the inflation outlook and the need to address elevated inflation expectations. The inflation and repo rate projections from the quarterly projection model remain a broad policy guide, changing from meeting to meeting in response to new data. The committee decisions will continue to be data dependent and sensitive to the balance of risks to the forecast. Stabilizing inflation at the midpoint of the target band will improve the economic outlook and reduce borrowing costs. Finally, we reiterate the views of the MPC on additional measures that would improve economic conditions. These include achieving a prudent public debt level, improving the functioning of network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains. Thank you very much for your attention, and at this stage, we would like to invite you to pose any questions that you might have to the MPC, and we would then address your questions. As usual, please identify yourself and the media house that you represent.
Good afternoon, Governor and the MPC panel members. My name is Ndando Tsukwana from Bloomberg News. Governor, could you speak more about the El Nino-induced weather patterns and how those could complicate your efforts in trying to bring down inflation? What do you see there? And also just an update on GFECRA on the transfer of the funds to Treasury. How far are we in that process? Has the transfer occurred, or are we still facilitating it? Thank you.
Afternoon, Governor and Deputy Governors. This is Kopa Nogumbi from Reuters. Two questions. I know you say it's a broad policy guidance, but in QPM, you've guided for roughly a 50 basis point cut this year. And given that you speak of so many upside risks, especially on the domestic front, How committed is the committee to achieving this by the end of the year? And then secondly, even though the committee has revised its own inflation forecasts up slightly, as you mentioned, inflation expectations are still above your desired point. Does this signal to the committee that respondents are making room for an additional hike, or how do you interpret the fact that the inflation expectations are still above your targets? Thank you.
Leanda? Oh, this one.
Good afternoon, Governor. I'm Balesa from CNBC Africa. Governor, we remember very well that you started hiking before the Fed. Was there any discussion of you expressed around the need to start loosening monetary policy? And my second question to you is, how difficult was it to reach what you have called a sufficient consensus at, or rather in arriving at today's monetary policy decision?
Zianda?
Thanks, Governor. The question is from Claire Bisseka at Financial Mail. How high is the bar for the first rate cut in the cycle? That is, how important is the Fed's first cut before the sub, that the Fed cuts before the sub? And how important is it that inflation expectations continue to fall all the way to 4.5% before you start to cut?
Thank you. Let me deal with this round of questions first, and maybe let's start right at the end. So Balesa asks that we hiked before the Fed, and have we considered cutting before the Fed? And Claire says, how high is the bar before for the cut before the Fed moves and the inflation expectations? So we don't follow the Fed. We watch the Fed, because the decisions of the Fed have got implications for the global economy, and that has got consequences for the South African economy. And so what the major central banks do, including the Fed, matters for global financial conditions. As they had embarked on a process over the past 2 years of tightening policy, global financial conditions tightened. And when that happened, we saw capital starting to flow back to the advanced economies away from emerging market economies. And that led to a realignment of exchange rates, and thus exchange rates of emerging market countries depreciated, and so did the rand. So we watch the Fed, but we do not follow the Fed basis point for basis point, or wait for them to do things. As a matter of fact, as we say in the statement, that there are a number of emerging market economies, mainly in Latin America, that have begun to cut rates. But there is something that distinguishes those economies from South Africa. Those countries tightened policy long before South Africa started tightening policy. And secondly, their nominal rates went way higher than what we had seen in South Africa. That meant that they were also able to rein in inflation earlier. And so their inflation has declined faster than ours has declined. And what you then have is that they now have higher real interest rates than we had seen earlier, because their inflation has declined and they had increased rates faster than us. So if you were to look at any of those countries, you will find that their real rates are something around 6%, depending, give or take, depending on different countries, whereas ours, if you take the 2026 forecast of 4.5, you would say that we are running interest rates of 375 basis points real. So we are still below those. So they have more policy room than we do. And that is why you could see them doing what they had done. What would be the bar for South Africa cutting the rates? The bar is the same. You just have to look at what is happening to the inflation rate and what is happening to the future trajectory of inflation. And to the extent that inflation is expected to decline to target and would be sustained at that midpoint of our inflation target range, which is 4.5%, then at that stage, the MPC could confidently look at that and say, is this sustained on a forward-looking basis? And then we will consider recalibrating policy as appropriate. And of course, what also matters here is the question that Kopano raises about the expectations that we see. And so expectations matter because they tell us something about future inflation, unlike the figure that you had seen printed last week. Because if you look at that figure from last week, you are basically backward looking. But we are also cognizant of the fact that the most recent inflation prints do influence inflation expectations. And that is why it is important that the actions of the MPC are forward-looking so that future prints of inflation are consistent with our inflation objective and thus help to bring inflation expectations down to the target as we have it. And so Kopano says the QPM had forecast cuts of 50 basis points for this year, and how committed is the MPC to realize that the QPM is one input into our decision-making process. And we will look at what the QPM says, and we can outsource our decisions to the QPM. We sit and we have deliberations about what the outlook looks like and what the appropriate policy would be to deal with that outlook, and what are the risks to the forecast, and whether those risks are materializing or are threatening to materialize, in which case we will have to consider policy appropriately to make sure that we deal with the risks. And so then this brings links back to the question of consensus, which Palesa raised, and how difficult is to, you said sufficient consensus? No, it's a unanimous decision. It is not just it's a unanimous decision of the committee. It's never easy. This MPC, there are 3 PhDs in these MPCs, and you put any 2 of them, each one of them will have 2 opinions. So now imagine with 3. And so the deliberations are always rigorous, and what is in no doubt is that we consider all angles, and eventually we arrive at a decision. And so it is never easy. The idea, it's always great to say that we have got unanimity, but we do not always strive for unanimity. We actually sometimes take pride that we come to you and says that there were different views in the committee, because it shows you that there isn't groupthink in the committee, that there are different views and there is a contestation of ideas, and that is very important for the arrival of an appropriate policy stance. Dalu, the El Nino weather conditions, we have highlighted this throughout last year, and it is becoming trickier. But now looks like the risk of to the crops could materialize more than what we thought of last year. As we pointed out, that there are dry and hot weather conditions that might be putting a a threat to the field crops. They might end up being less than what was expected. As a matter of fact, the national crop estimates had already come up and revised their output for crop estimates this year lower. And as we would have seen in the past, that poses a risk to food inflation, and that complicates the disinflation process that we had actually seen. GFACRA, there is a piece of legislation that must be passed, which is called the Appropriations Act bill at the moment. Until such is passed, there will be no transfer that will take place from GFACRA to the Treasury. Hillary.
Hillary Jaffe from Business Day. A follow-up question on the GFACRA. How does that make your implementation of monetary policy more complicated? And at least in simple terms, can you run us through how that affects the day-to-day of monetary policy and whether it has any influence on monetary policy decisions, because you're pumping a lot of money into the market? And second, unrelated question, there are 5 of you on the committee this time. We are looking forward to 6 of you next time, with Mampo Modise joining you. You'll then have an even number again and a casting vote for you, Governor, which I know is not the ideal. Will you then be looking for a 7th member of the committee?
Thank you. You know, I have said so much about GFACRA, and when I am tired of saying it, I ask DG Kasim to say it. Maybe now that we have got a new kid on the block, who is in his 2nd MPC, I give this question to him.
Go for it. Okay, thanks, Hillary, for the very easy question. As you know, it's an extremely complicated subject and very hard to explain clearly. So we expect to expand the liquidity surplus. We operate a surplus system for monetary policy implementation since mid-2022. The idea here is that we pay interest on excess reserves, like a lot of other big central banks. We pay that interest at the policy rate. If banks have got a better idea for what to do with the money, then they can go and do it. But depositing money at the central bank means it's very safe and it's very liquid because it's cash. It's in your current account, literally. So it doesn't make a lot of sense for a bank to go and buy some other asset that pays less than the policy rate if they can just get the policy rate with us. So the expectation is there's more money in the system, but it all comes back to us at the end of the day, and it doesn't change in a very large way financial conditions. The banks just have a bit more liquidity. When we built out the surplus system, we think that got rid of some distortions. We saw some movements in year-term rates, JIBAR, the FX implieds. They compressed towards the policy rate, probably a good thing. In 2023, when we expanded liquidity from about 45 billion to about 80 billion with the drawdown of the sterilization deposit account, which is Treasury's money, we saw very small impacts on market rates. And our understanding of that is that once the market had more cash than it needed, putting more cash into it really didn't change a lot. This is a larger amount of money that will phase in. We plan to do it quite slowly. We plan to tell people in advance how the liquidity position is going to evolve. We want to have a smooth transition like we achieved with the last 2 surplus changes. We don't want to surprise anybody. We don't have a material change in financial conditions. And so the policy stance should continue to be captured by the repo rate, which is set by the MPC, and not by another variable, which is the amount of liquidity. So it's still, you want to know what the policy stance is, it's the policy rate. Thanks.
Zianda?
Thank you, Governor. The next question is from Eldrin Simpier at SAFM. He's asking, Governor, at the FSCA industry conference, you said you were confident that we will exit grey listing by 2025. What informs this confidence, as some analysts say it could be 2026, also considering the lull that normally comes with the general election season?
Is that it from online?
We've got 3 more questions, Governor, from the same person.
Yeah, okay.
Okay.
Go on, Eldrian.
It's Atul Dlamini from Alliance News, Governor. The MPC statement says major global central banks are expected to cut rates at a slower pace and to start cutting at a later stage. Is this the scenario that is likely to play out in South Africa? CPI has risen for the first 2 months of 2024. What do you read into this increase? The third and last question, Governor, is inflation expectations suggest that CPI is unlikely to return to 4.5 midpoint. To what degree does this worry the MPC? Thank you.
Okay, thank you very much. I got David to deal with Jifekra there. Hilary, I've not forgotten your MPC question. I'll come back to it. DG Fundi, you are more optimistic than I am on the grey listing being removed in 2025, so I will ask you to deal with that question.
Thank you. So the grey listing is more like a relay race. So there are a number of government departments that are involved. Some of the requirements relate to supervision and regulation, and that's the area in which we, the South African Reserve Bank, have got responsibility. Some measures relate to financing of terrorism, and that requires law enforcement and intelligence agency involvement. And there are some that involve departments like, or the areas like the Master's Office or the companies and intellectual properties area, which are responsible for the registration of companies and trusts. And then there is general requirements around law enforcement and prosecution. So the reason why we are optimistic on one part is that in terms of the technical requirements from FATF, meaning, or from the Financial Action Task Force, do we have the laws that allow us to tackle money laundering and financing of terrorism? We have passed a big chunk of that requirement. Where we are now is the work where they test our effectiveness. Are we implementing our own laws and our own rules, and can we do that consistently? And these are areas that we are working on. So, Eldred, I would say that departments are working steadfastly on this, and the bulk of the work is done by technocrats and not by our political principals. We do have the necessary support at that level that has come through from Cabinet. But in terms of your concern that there will be a lull after the elections, the bulk of us that are getting this work done under the leadership of the Treasury are our technical people. There are areas of vulnerability that we are aware of, and some of those relate to how steep some of our penalties, financial penalties that we give on institutions are. There are some capacity challenges in law enforcement and some on the prosecution side, but we are working in partnership with the private sector. We're required to see how we can enhance the capacity. But we are all steadfastly working to achieve our 2025 deadline.
Thanks, Fundi. Rashad and Chris, one of you must deal with the pace of the major central banks and how it impacts on our pace, and the other one of you must deal with the rise in CPI early this year and the impact of expectations and whether we are confident that we could bring this thing down to 4.5%. Choose my scatter.
Okay, let me take the CPI one and leave the difficult one to Chris.
You decided, yeah.
So we've come to the conclusion, not surprisingly, that CPI is sticky. It is sticky in our economy as it has been in many other economies. So while many economies are celebrating with constraint the fact that inflation is on a downward path, there is a big debate. There's still the last mile to go. So, we're not surprised that CPI has increased in the last month or so. And the main reason we're not surprised is we did expect, to some extent, with the depreciated exchange rate, fuel prices to pick up. We expected medical insurance to pick up, and medical insurance increased more than the market expected. The real question for us is not necessarily the current data, but what does the current data tell us about our forward-looking measures? So, similarly, let's, for example, say that CPI in the last 2 months went on a declining path. We still wouldn't take the comfort, because we have to make a judgment about what that means for the forward-looking nature, because our decisions are based on what we think is going to happen in the future. However, what we think is going to happen in the future is not done independently of circumstances and data today. That's why we often say we data dependent. So this is why we flag upside risks in the statement. We're saying that in the model and in our forecast, we say that CPI will get back to 4.5% by end of 2025. But lots can happen. Lots can happen in between. We are aware of some of these risks, and that's the way we treat it. The real issue is, have we reached a peak in inflation? Will it go down, or will there be surprises, another oil shock? Those are the kind of things that we look at. But just to reiterate, it's really the long run that we're interested in. Thank you.
Chris?
Thanks. Delighted to say that I agreed with all of that. So, on the slower cuts in the rest of the world and also in South Africa, I think the governor largely answered this question earlier. I mean, this really depends on what the advanced economy central banks decide to do and how they read their own inflation outcomes and how they think that their own policy trajectories are going to impact on those inflation outcomes. So what they do will depend on their analysis of what's going on in those economies. If cuts are slower, it does raise a little bit the risk to South Africa and other emerging markets, because it puts a bit of upward pressure on the exchange rate. So there's more depreciation pressure on the rand, and that can have inflationary effects. But at this stage, it's really too difficult to tell exactly what the pace will be in the rest of the world. Obviously, we discuss it and we take a view on it for our own assessments. And the same kind of calculus for the rest of the world applies to us. So we will judge our rates trajectory by the degree in which our own inflation rate starts to go back down to the midpoint of the target band. The forecast indicates that the baseline is that will happen, but our view is that it will be slower than we expect it to be. Thanks.
I do not see any further questions. There was Hillary's outstanding question. Did you have another question in addition to your outstanding question? Okay.
Governor, I'm just trying to clarify. I mean, your inflation forecasts on average have actually not changed very much. It's 0.1 for this year on average and unchanged for the next 2 years. So when you say that cuts are going to be delayed, where is the weight of that sort of caution, if you like, coming from? Is it from expectations mainly? Is it from the forecast itself? Is it from the global? I'm just trying to clarify what's driving you to say that. And the other question, where and how does election risk, whether our elections or US elections or any other material elections for us, is that something that factors into the committee's thinking?
Kopan.
Similar to Hillary's point, I
think I'm going to move you to sit next to Hillary.
You answered me in part on both questions. So just to follow up exactly what Hillary's saying, especially on expectations, Help us understand this. The fact that expectations are significantly above your own forecasts, even though you've revised up your forecasts, what does this tell you about what the market is thinking about where inflation is going? Does it signal to you that perhaps you're not doing enough to beat inflation and so it does make room for a hike? Or because you often talk to us about the transmission and the time it takes for rates to work their way through the market, but we've had sustained 8.25 for quite some time, and if expectations are still above that, how do we interpret that for you? How do you guys interpret it, and how do you help us interpret that? And then, again, I know you say QPM is just one guide, but again, similarly to Hillary, are you committed to following this policy path that sees us cutting rates later this year, given all of these risks that you've highlighted? I know you say QPM is one, and yes, there are others, but still, it's in the document. Thank you.
You've answered yourself. But
Alex Winning, also Reuters. I'm also piggybacking off Hillary, but I'm sitting next to her. I want to ask about the timing of the next MPC meeting, which is going to happen the day after the election. Did you consider moving it? Is it potentially quite a difficult time to hold an MPC meeting when there might be a lot of volatility in the market? What are the chances that the decision will actually be announced on that day? Could it still be moved? Thank you.
Okay, thank you very much. Hillary, yes, the forecast has not changed much from the previous meeting. But the trajectory of the forecast had been to revise the inflation forecast higher, which might suggest that some of the risks are materializing. And one of the risks was raised by Dalu, which had to do with the El Nino effect, that we are already seeing that setting in. But we had also highlighted the spillovers from the policy stance of the advanced economies and what it means for exchange rates globally. And what we have seen is that many emerging markets, almost all emerging market currencies, had depreciated against the G10 currencies. But also more importantly had been that in our case, the rand had tended out to have weakened more than many of our peers. It's risk-based. Don't try and look for one indicator that we would pick. And the fact that expectations, although they had declined, are still elevated is a point of concern for us. But unlike you, Hillary, Kopano says the market expectations, and I need to distinguish that. In the survey of inflation expectations by the Bureau of Economic Research, it's broken between business people, labor, and market analysts. The market analysts are very much aligned with us. They are very much aligned with us. Part of it is that they have got access to the QPM. They can play around with it. They can forecast this. They have built their own models. They can change the assumptions and input different assumptions and see how. And so you will find that theirs is always almost in line with us. But market analysts are not price setters. The price setters is labor for the price of labor and business people for the price of goods and services. And so we watch those closely. And it has been of particular concern to us about business price setters because their expectations had been elevated for actually such a protracted period of time. But you raise a fundamental question. Are these price setters saying they do not believe us? Or are they seeing something we are not seeing? Because if they do not believe us, we can make them believe us. And the only way to make them believe us is to demonstrate that we are doing something about inflation. For now, we believe that the steps that we have taken had put monetary policy stance in a restrictive zone to the point where we believe that where we are is consistent with the outlook of inflation and the risks that we have identified. Of course, if those risks materialize, it will cause a different discussion within the MPC, and we might have to consider monetary policy differently. And so that we would watch that. And you said, again, back to the quarterly projection model. And it is the quarterly projections. So it looks at these things in quarters. It does have a component within it that deals with expectations. And we weight these expectations between backward looking, or rather I would say model generated inflation expectations and surveyed business inflation expectations. And those feed into the quarterly projection model. The quarterly projection, we consider it. We see what it says about the inflation outlook and about the growth outlook. We deliberate, and different members of the MPC would say that, well, these are what we had agreed on, but my view on this and that is different from yours. And based on that, I actually think this is where the things are going. And that is why you will find that bar the good few past meetings we have had where we had unanimity, you would have had split decisions. It has to do with the role of judgment of the MPC members. They are not machines. They can't just be programmed and follow the QPM. They apply their mind and express views about what the policy stance is and do it as appropriate. There are a couple of times where we had to take decisions contra to the QPM. There are times when the QPM, like in 2020, the QPM said, we expect you must cut rates for the next 3 quarters, you must cut rates at every meeting for 25 basis points or so. And we said, no, we're not going to wait for that. We are doing it all now. And again, it had to reflect judgment by the MPC and not just religiously following the model. The model provides the guide for us. It is one input into the MPC decision-making process. Well, thank you very much. I thought that we are done, but that is the last question, because I had to deal with questions here. Okay.
Elections.
Yes.
Okay, thank you, Governor.
Elections. Yes, the IEC is coming. No, there's a question at the back behind you.
Monique from Bloomberg. I wanted to know the QPM, how many rate cuts was it projecting for 2024 now compared with its January forecast?
Okay, Chris, that's your question. It's an easy one. Hillary, the MPC, we can have up to 8 members. So even if we were 8, we will still have an even number. Okay, we have moved from an odd number to an even number. One would say probably ideally we should have 7. We will continue to hunt for the 7th one. But as sometimes experience shows, you go hunting out there in the bush only to find that you should be hunting at home, and we might just be able to hunt at home again and find another one. And Alex, the thing about the elections, in the November meeting last year, we announced the MPC dates for the year. The president decided to announce elections to be on the 2nd day of the MPC. So what were we to do? Bring the MPC forward so that the decisions are made before the elections? Or wait for the elections and make the decision afterwards? Both ways there would still be uncertainty. Because the fact that the elections have taken place does not mean that a government has been formed. There will still be uncertainty about how is government going to be constituted and all of that. And considering the two pros and cons of that, we decided that we will keep the MPC date and the announcement date to be the same. In any case, the thing we deal with uncertainty all the time. Elections are just but one uncertainty we have to deal with. I can tell you that the QPM does not have an election variable or a political variable in it. So we will still make decisions the same way that we would. The only difference is that the Wednesday, the 29th, will be a holiday, which means some chaps will have to quickly go vote and then come back and worry about the MPC, and then we would still make the announcement on Thursday. So normally the IEC makes the announcement about the election results over the weekend. So I take it that you and I still have an appointment for Thursday, the 30th of May.
Thank you.
That concludes the proceedings of today. Thank you very much for your attendance. I will see you on the 30th of May.